Just start with the recording and just let me know if I'm audible and visible to all clearly. Just give a heads up because without wasting any time, we shall begin with the session. If I'm audible and visible to all clearly, yup. Okay. Thanks. Okay, so the few of the people that who requested me about these concepts, like maybe for their interview purpose or maybe for their practical understanding because they have started using these tools in their on-core job and they want to understand this because there were multiple people who started their roles into a multi-asset specialist role or the people like who were into the fixed income profile and they started working with these concepts in their actual job role of Z spread or the option adjusted spread. And most of them are appearing for the interviews. So it's my duty for them to cover about all these concepts. So yeah, so without wasting any time, we shall begin with the first topic for today, that is convexity. So convexity is something which is an extension of our previous sessions, the previous recorded sessions. And again, I'll be keeping separate sessions upon the previous concepts of duration as well, because convexity is something which is an extension of duration. And we all know that what is duration. It talks about the inverse relationship between the price of the fixed income instrument and the yield commanded upon that fixed income. That is, if the yield in the macro market rises, the price of the fixed income falls. If the yield falls, the price of the fixed income instrument rises. And we have talked about this in the previous sessions, and the recordings of those sessions are available on the website as well. But do not worry, I'll be covering that concept specifically in further sessions as well. So just taking that concept of inverse relationship between the fixed income price, the price of the fixed income instrument, and the yield commanded upon that fixed income, we'll be taking our discussion forward and talking about convexity. So before we try to understand convexity, it's important to understand duration. And I gave you a fair understanding about the concept of duration. So here we are with this convexity. So what exactly is convexity? Again, it also talks about the inverse relationship between the price of the fixed income and the yield. But what exactly is the difference between duration and fixed income? Between the convexity and duration, sorry. So like when we talk about convexity, convexity implies larger changes in the macro environmental conditions, specifically interest rates. So whenever I'm talking about duration, it talks about the inverse relationship between the price of the fixed income instrument and yield. So in that scenario, the yield changes by a smaller magnitude. So for smaller changes in the magnitude of yield, duration is a good concept. But it's not always mandatory that the yield will change by a smaller amount. If the yield is changing by a larger magnitude, in that case, convexity is something that we can use. So one difference between duration and convexity is duration accounts for minor or smaller changes in yield and its impact upon the fixed income instrument, whereas convexity, it accounts for larger changes in yield on the price of the fixed income instrument. The second and the most important difference is that when we talk about duration, it talks about a linear relationship. That is, if the yield is rising by 1%, the price of the fixed income will fall by 1% only. Or if the yield is falling by 1%, the price of the fixed income instrument will rise by 1% only, not even by 1.5 or 0.5%. But that might not be there in the real life. Just for the purpose of theory, that definition is completely fine. That shows a linear relationship. And as you can see clearly in this graph as well, if you can just see this graph, the graph also clearly shows you a straight line. So I will just use the marker here. Let's go to draw. Yeah, just taking up a marker. And here you can see the straight line that shows the bond duration. So here it shows a linear relationship between the price of bonds or fixed income instruments and the interest rate. And here the fixed income instrument can be any of the fixed income instrument. It can be a bond, it can be a debenture, or it can be any other kind of complex fixed income instrument, right? So that we need to understand very clearly. Okay, so that is something. But in terms of convexity, as I told you, the relationship of linearity between the interest rates and bond prices might not always be linear. It might happen if the yields are falling by 1%, the price of the bond rises by 0.8% or 1.5% per se, and the vice versa is always true. So the exact curvature of this relationship ideally is a curve. It is not always a straight linear relationship. Duration shows a linear relationship, which might not always be true in the real life. Convexity shows a curvature relationship, which will be true in 99.9% of the cases. So this curvature relationship between the yield and the price of the bond is convexity. That shows the curvature in the relationship. And convexity is also considered as a friend of the investor or as a friend of the person who is investing into fixed income. Why? Historically, or the previous history, including the current time, shows that when the yield when the yield on the fixed income instrument rises, the price of the fixed income instrument falls by lesser amount. But when the yield falls, the price of the fixed income rises by a larger magnitude. And that is why we tend to call convexity as the friend of the investor, as a buddy of the investor. Because if the yield is rising, the price of the fixed income instrument is falling by a lesser magnitude. But when the yield is falling, the price of the fixed income instrument is rising by a higher magnitude. Right? So that is why we tend to call convexity as a buddy of the investor. And here we have a manual chart created by me in some of my previous sessions where I clearly show this difference. The straight line is the linear relationship, encapsulating the concept of duration, talking about a linear relationship, a linear inverse relationship between the price of the fixed income instrument and the yield. And here is the curvature relationship, which clearly shows if the yield is falling, if the yield is rising, the price of the fixed income instrument is falling by a lesser magnitude. But if the yield is rising, the price of the fixed income instrument is falling by a lesser magnitude. But if the yield is falling, the price of the fixed income instrument is rising by a higher magnitude. So that is something that we need to understand in terms of convexity. So I'll be sharing these slides with you as well. You guys can read this theory also. Okay. But just to give you a understanding about these concepts and all these things like which I'm telling you in simple language are being encapsulated here only. So do not worry about this theory section. Okay. Like you need to understand stuff practically. And here I talk about the formula for convexity. Though not ideal for everyone who is here, but the people who are ideally using this thing, because now people tend to calculate convexity in Excel, right? The manual way has gone, but still the formula for convexity is being clearly mentioned in here. And what does the formula for convexity tells us? It gives you a P plus, that is the bond price when the interest rate is decremented or the interest rate falls. P minus is the bond price when the interest rate is incremented. That is when the interest rate is incremented, the fallen bond price. PO is the current bond price divided by 2 plus PO, the current bond price or the bond price in at a stage of 0 into this delta change. This delta Y is the change in the interest rates in decimal forms. Okay. So for example, if the current bond price is 100, just assume if the current bond price is 100, the yield is 2% and the yield rises to 3%. So if the yield rises to 3%, the price of the bond might fall. Just assume it falls to 98. And in the other scenario, the yield falls by 1%. In that case, the price of the bond rises. So assuming it to be like 102. So in that case, what we can do? P plus, it basically states the bond price when the interest rate is decremented. When the interest rate falls, the bond price rises. So bond price kitna ho gaya? It is nothing but your 102, right? Plus the fallen bond price when the interest rate is incremented. How much was the fallen bond price? It was 98. So it is the final bond price, right? Just a second. Yeah. Minus 2 into this 100 bond, the face value of the bond, whole when we are dividing this equation by 2 into this face value or initial price of the bond into the change in the interest rate. What has been the change in the interest rate? It has been by 1%. So 0.01 ka square. So once you do it in that scenario, you guys can calculate convexity. Though there are like bigger formulas to calculate convexity that confuses the people, but this is a CFA formula like which I'm telling you, a CFA short end formula. Because like many of you might be giving CFA examinations as well or might have given already. So people who might have given already might know about this formula. But those who are giving that CFA exam, it might help you to calculate the convexity in a very short time, because CFA is very time constrained and you have to solve all the questions in limited time scenario. Okay, so this is the easiest way, and this is through Excel. A very simple example through Excel. How can you calculate convexity? Having the cash flows, having the time periods, calculating the present value of the cash flows, taking the weight of each cash flows as a percentage of total. So these are nothing but your weights of the cash flows. And here I have just tried to talk about convexity is equals to the sum of t into t plus 1. T is the time period. So it is 1 into 1 plus 1 for first period, because t is 1. 1 into 1 plus 1 into the weight. So weight is nothing but 4.61 into 1 divided by 1 plus y, right? So that is the thing that you have to take into consideration while you are, and y is nothing but your yield, right? The yield in the first year. And when you calculate all these things for 12 years, you tend to get convexity, right? Which is nothing but your 105.0573 annual convexity. And if you want to find it in a semi-annual basis, just like divided by 4, because you have like 4 quarters in 1 year. So per quarter convexity like you'll be getting, right? So that is something that we need to understand in a very simplest manner, though I'll be covering these concepts specifically, like one session or two sessions for duration, one session or two sessions for convexity. So do not worry upon that. This session is completely for those people who want to understand these things, right? Quite, I would say, like immediately, right? Or the job demands that. Okay, so not to worry about that. It's just an extra additional session. Okay. Now we have this concept of Z spread. So what exactly is Z spread? So before we try to understand Z spread, we need to understand the difference between the yield spread and the corporate spread. So both of the spreads do not mean the same thing. Both of them are different. Do not use them identically. Yield spread is the difference between the treasury bonds only, the yield on a long dated treasury bond and the yield on a short dated treasury bond. So if we talk about the yield spread, it talks about the difference between a 10-year treasury bond yield and a 5-year treasury bond yield. So for example, if a 10-year treasury bond yield gives you 7% and a 5-year treasury bond yield gives you 6%, in that case, the yield spread is 1%, right? So yield spread, it just takes the difference in yield of government securities or gilt securities or treasury securities. But when we talk about corporate spread, it takes the difference between a corporate bond and a government bond. For example, if the corporate bond is giving you an yield of 8% and the government bond is giving you an yield of 5%, in that case, the corporate spread is 3%. So one thing we need to understand, yield spread is the difference in yield of the government securities only, whereas corporate spread is the difference in yield of a corporate bond and a government bond. And what is the connotation? What is the interpretation is vice versa. Ideally, we want the yield spread to be expanding, because when the yield spread expands, that is, the yield on longer dated securities is higher than the yield on shorter dated securities. That is, we have a rising yield curve, as we can see in this slide. A rising yield curve or a positive yield curve or a steepening yield curve. That is, the yield on longer dated government securities is higher than the yield on shorter dated government securities, because the yield curve is steepening. The yield spread is expanding, right? It is expanding or it is widening. In that case, it's a good scenario. It indicates a boom period, a good economy, a period of expansion. Whereas when the yield spread contracts, it means the difference has become negligible between the long dated security yield in case of government security and a short dated government security, or the yield is becoming negative. In that case, it's a fear of recession and we face an inverted yield curve, right? An inverted yield curve or a contracting yield curve. So the yield spread should expand and never contract ideally. And the corporate spreads interpretation is vice versa. If the corporate spread is expanding, it's a fear of recession. It's a fear in the market. And when the corporate spread is contracting, it can be a period of expansion or a good period. So currently, if I talk about US, in US, the yield curve is expanding now. Now, people might argue that the yield spread in US is negative, right? Because the 10-year yield curve, it gives you around 7.6%. And the 2-year yield curve, it gives you around, the 10-year yield curve, it gives you around 7.2% currently, if I'm not wrong. So the 2-year yield curve is giving you 7.2%, right? If I talk about the 2-year yield curve, the 2-year yield curve is giving you 7.6%, and the 5-year yield curve is giving you 7.2%. So the difference is, it comes out to be minus 0.4 approximately, right? So in this scenario, we can say the yield on a shorter dated government security is higher than a long dated government security. And the yield spread, it turns out to be contracting and negative. But this number of minus 0.4% was minus 1% at some point of time. It was minus 0.8% at some point of time. Now it is coming down to minus 0.4, minus 0.3. It's going towards a positive trajectory. In that case, we can say the yield curve is expanding now from a negative number to a positive number, or it would be almost flattish. The yield will be almost same. And that is why the analysts are saying that there would be a soft landing in US. There won't be a clear recession because the yield curve is not completely inverted. It is now flattening and going towards a flattening stage. And we might have a plus 0.4% in the coming days, right? So the yield spread is expanding. First, it will flatten, as in this third scenario, like we can see, where the yields will almost come at par, or the difference would be like very less. Maybe just like minus 1% basis points, right? Or like minus 0.01%, or like 1 basis, because like 1 basis means 0.01%. 2 basis, 0.02%. So it is 100th of a percent, right? In terms of basis. And if I talk about corporate spread, in the real life, the corporate spread will not exactly contract by the same magnitude. The corporate spread will contract, but the magnitude by which it contracts would be very less as compared to yield spread. So in the current scenario we see in US, the yield spread is going towards the flattening stage or expanding stage. And the corporate spread, though it is expanding, but now it is expanding by a lower magnitude. So it's a good signal for the US economy. In India, both the 10-year and 5-year are at 7.2, 7.3%. So in that case, in that case, there is no fear of recession because in India, the yield curve is almost flat. Okay. So that is the difference that we need to know. And further taking this to the concept of Z spread. So Z spread is nothing, but it's a very simple concept. Because the term is a bit complex. Z spread or Z spread, popularly it's called as Z spread in finance world. The thing is, we've all talked about how, or we all might be knowing how to calculate the present value of cash flows, or how to calculate the intrinsic value of a share. We have discussed that in recorded sessions. I'll be keeping separate sessions upon that. Not to worry upon that. That's guaranteed. But the thing is, the basic terminology that we know, that whenever we are calculating the present value of something, be it the present value of an asset or a present value of a share, right? We are discounting its future cash flows by a certain discount rate. And when we are discounting those future cash flows by a certain discount rate, we tend to get the intrinsic value, right? So what basically happens in the scenarios, all the cash flows that you might receive in year one, in year two, in year three, in year four, you might be just discounting it by a certain rate. And that certain rate is the discount rate, which encapsulates the risk in that particular company or the risk in that particular asset. And you tend to add all these discounted values to calculate the present value of an instrument or an asset or a share per se or a stock per se, right? So what exactly is a Z spread? Z spread is more used in the fixed income world, right? So when you want to calculate the price of a fixed income security, same way the price of a bond can be calculated. If you want to calculate the intrinsic value of a government security, how to calculate the intrinsic value of a government security? Same way as you calculate for equity. All the coupon payments that the government, so for example, if you have a bond of 1,000 that gives you 10% rate of interest for 5 years, it means that for 5 years, like you're going to get a coupon of 100, 10% on 1,000 makes it 100. So you're going to get a coupon of 100 for all the 5 years. And in the 5 years, even the face value would be returned to you. So in the face value like you'll be having in the fifth year, 100 plus 1,000. And like you're going to discount these values by the government risk-free rate, which is the yield on government securities, and add all these values. discounting all these prices, all these coupon payments to be received on the fixed income instrument, and you are dividing all these coupon payments by the rate of interest, R. Correct? So that is something that is going on. So that for a risk-free bond or a government security or a treasury security. But if you want to value a corporate bond, the corporate bond is not risk-free. The corporate bond can default also. Even the government bond can also default. There are certain reasons and deliberations for that. Like we can discuss about that in separate sessions. But the corporate bond has a higher riskiness as compared to a government bond. The corporate bond can default, right? And has a higher probability of default as compared to a gilt security. So you cannot use the risk-free rate to discount this bond. You have to use a higher risk rate, a higher discount rate, and you need to add something to it, right? Which encapsulates the risk of that corporate bond. That's something that you are adding to this risk-free rate is your Z spread. The something that you are adding to the risk-free rate is your Z spread, as you can see here. So for example, if you have the market price of the corporate bond being 104, it gives you a coupon of 5. In third year, like you'll be getting 5 coupon and the face value of the bond, assuming the face value of the bond was 100. The market price of the bond is 104.90. 5 rupees ka coupon you are getting. That is a 5% coupon that you guys are getting on a face value of 100 rupees, 555. And in the last third year, you get 5 plus 100. That's a 105. 2.5%, 2.7%, and 3% is the risk-free rate. We're adding something Z to it to encapsulate the risk of that corporate bond, right? So that Z, once you calculate by using this formula, Z as a figure that you have to calculate. So it comes out to be the value of Z. So like whatever value that like you're gonna get for Z, right? With the correct Z. So that would be the value of your Z spread or the additional risk that they have taken to purchase this bond, right? And that is why the major reason is you will have the market price, face value, everything. The Z spread is nothing but the value of that additional risk that you are taking to purchase that bond, right? It's the basic formula to calculate it. Some components are there to calculate the Z spread, right? Like you need the spot rate curve. The spot rate curve is nothing but it's the same curve as we saw previously. This yield curve is the spot rate curve. You get different maturities. You get the yield on a fixed income instrument for different maturities, right? Along this yield curve, right? You get the interest rate or the yield for different maturities along this yield curve. Okay. And the second requirement, then you have this yield to maturity. It is the final return that the investor gets if he's holding that fixed income instrument till maturity from the price perspective and from the yield perspective. Then you have the present value of cash flows, and we know that what it is. Then you have a clean price. So clean price is something, a bond price excluding accrued interest used for Z spread calculation, right? So like whatever pricing is being used to calculate Z spread, it's a clean price. That is, it does not include accrued interest. And what do I mean by this concept? See, whenever the bond, like whenever you are purchasing a bond, okay, there is always an accrued interest that is to be paid on that bond. Either on an annual basis, some interest is being accrued on that bond, which has to be paid. Correct? So like when we talk about that zero coupon bond, what's a zero coupon bond? In case of a zero coupon bond, it is purchased at a discount and sold at the par value. So the difference between the par value and the discounted price is your return that the person makes, right? So whenever they're purchasing that bond, there's always an interest component that is due after 1 year, right? So it can happen. See, for example, if you have purchased that bond for 100, right? The interest component of 5 is due for first year, then 5 is due for second year, correct? So whenever that interest component you are taking into consideration into this price, this 5 rupees is nothing but your accrued interest. But whenever we are calculating this, we are excluding this accrued interest. That is, we are just using 100 as the face value in the calculation and the market price being 105. We are not adding this 5 plus 5 plus 5 in the final face value, in the final price. Because see, like what is happening? If we have purchased 100 rupees का face value का bond for 2 years per se, ठीक है? 5 rupees you get in first year, 5 rupees you get in second year. Okay. So this 5 you will get, यहाँ पे like you will get how much? Like 105 plus 105. So final return was nothing but it was 110, right? So like 110 you got, correct? So we are excluding this accrued interest. That is, we are excluding this 5 and 5 from this calculation. हम 110 में से we are excluding this 5 and 5 for each step of calculation. You just have this 100 and this 105 for the purpose of calculation. And that is why we tend to mean that bond price excluding the accrued interest, right? So that is the case. We are using 100 and 105, right? Not the 110, which has 5 plus 5. Okay, so like that's the logic. And the factors affecting the Z spread, you have interest rates. So when the interest rates rises, the Z spread falls. And why the Z spread falls? Because when the interest rates are rising, even the risk-free bond will give you a higher rate of interest. Then why will people go for the corporate bond? Then you have the issuer's credit worthiness. If the issuer's credit worthiness rises, right, the Z spread falls, right? Because Z spread is a measure of risk. If the credit worthiness is falling, in that case, only the Z spread will rise. If the market liquidity is tight, that is, there are less buyers and sellers. It means there is riskiness for that corporate bond. You cannot sell that corporate bond. In that case, the Z spread would be higher. Then you have the time to maturity. A higher time to maturity is more prone to interest rate risks. And in that case, the higher the time to maturity, higher would be the risk for that fixed income instrument. And in that case, higher would be your Z spread. So that is the thing that we need to understand. And here's an Excel calculation. I'll be like explaining this calculation to calculate Z spread by using the goal seek function in Excel in a separate session. Then see, the one thing that we need to understand is that whenever we talk about a Z spread, it only works for a bond which is not callable or puttable. So what's a callable bond and a puttable bond? So a callable bond is something that can be called off by the issuer. For example, if the current interest rate in the market is 5%, the bonds are issued by a particular company guaranteeing that the company would be paying 5% to those investors with a call provision. If the interest rates fall in the market from 5% to 3% per se, just a basic example, then why will the company want to pay 5%? The company will pay that I will just pay 3% now, right? Because if the company is paying 5% instead of 3%, the company is paying over expenses by 2%, right? So in that case, the company can call off the bonds. The company can say to investors that I am calling back my bonds. That is, I am taking my bonds back and you guys shall get your money. The company which has issued the bonds is taking back the bonds from that investor. So that's a call provision. And what's a put provision? A call provision is from the company's point of view. A put provision is from the investor's point of view. If an investor feels that he is getting 5% interest, but hypothetically, if the interest rate in market rises from 5% to 10%, then why will that investor want 5%? He'll say that I want 10% now. So he will call the company and say that I am returning back my bonds because I want to purchase a high yield bond. So that's a puttable provision. So callable and puttable provision, it doesn't work in Z spread calculation. If a bond is callable or a bond is puttable, you need to have an option adjusted spread, right? You need to have an option adjusted spread. Okay. So when the bond is callable or a puttable, always use an option adjusted spread. And the difference in the Z spread and the option cost, because like whenever you are purchasing a call option or a put option in the market, you have to pay an option cost. So when you subtract that option cost for a call or a put from the Z spread, you tend to get the option adjusted spread. Okay, so that is the option adjusted spread or the Z spread calculation that you get in here. Okay, so your option adjusted spread is nothing but the difference between the Z spread number and the option cost. That's it. And here's a typical graph to show it, right? And here's the Excel calculation. Not to worry about that. And after that, you have one more concept like which I shall discuss before ending the session. You have something as your spread duration. Okay. So spread duration is the measure used in the fixed income investing to estimate the sensitivity of a bond price to the change in the credit spread. It basically means what is the impact upon the price of the bond when the credit spread changes. The credit spread is same as corporate spread. So when this corporate spread is changing, what is the impact upon the price of the fixed income instrument? So you tend to take into consideration three components of calculating the spread duration. So you tend to take into consideration your yield to maturity, and we know that what is YTM. We know like what is the option adjusted spread, and we also know that what is the modified duration, which talks about the inverse relationship between the price of the fixed income instrument and the bond, right? And here is the formula for that. That is the option adjusted spread divided by the yield to maturity into the modified duration. So before you calculate the spread duration, you need to have these three parameters with you, correct? Until and unless you don't have these three parameters, you cannot calculate spread duration. Again, these concepts being more important from a CFA perspective, CFA level 3, right? But since I'm getting the request from a few of the candidates who are appearing for interviews and doing such roles and doing such things actually and want to understand such things, so it was a brief understanding for them what exactly is this stuff. Because the job for you guys would be far more easier because the guys would be calculating such stuff by using a pen and a paper. The guys will be having the Excel tools, right? So always, and of course, there's a separate session for those specific guys as well who want to understand these things in a very deep manner, right? And we'll be having the sessions with you as well, with the general audience to understand these things very deeply sometime in future. So not to worry about such stuff. Any questions till now? Just post your questions in chat box. I'm waiting for your questions. Just put in your questions in the chat. Okay, Charisha. Umesh also has a question.
Yeah, hi Maurya. So when you were talking about the yield curve spread, okay, inverted yield curve,
Mhm.
what I've observed is this was the, during like July 2023, it was the highest inverted yield curve spread for 10-year bond and 1 year US bond. It was somewhere around negative 1.4. Now it's reducing. But if we see the historical chart, whenever there is an inversion, it comes back to the zero line, right? That is when there is a recession.
Mhm.
Like during the 2008 crisis or the COVID crisis, always there was an inverted yield curve. Then when that has, that curve has started rising again back from the inverted position, that time there is a recession. So do you think there is any chance of recession, or it's
See,
going to be
I
very
was
soft line?
yeah. So I personally like if I give you my personal opinion, so I personally like don't think that there will be a complete recession in US. Because apart from the yield curve, there are like multiple indicators. Yield curve is something that the guys are using to gauge that fear of recession or not. But the thing is, apart from yield curve, the thing that they're taking into consideration is inflation. Inflation being around 3.5% around in US. Again the quantum of inflation or the rate of inflation is coming down. The second parameter that they tend to take into consideration is your the wage growth and employment. Again, the wage growth and employment is pretty strong in US. In the previous history, the wage growth and employment was really bad. People were struggling there. As per the numbers I'm telling you, of course, like there can be some nuances. And also, like if we talk about the corporate earnings in US are also really good now because like whenever we face the period of recession, be it in 2008 or 2002 or the 1992 phase, in that phase, like even the corporate earnings were really bad. The corporates were suffering. The corporates were in huge debt. Though the US economy as a whole is in debt, but the corporates are much better. The corporates are providing great earnings. The corporates are doing really well. So all these scenarios are paving a positive picture apart from that inverted yield curve. And again, like coming back to your point, like whenever the yield curve is inverted, we have a recession. There is a difference between the recession and soft landing. Soft landing is also a type of recession. So here we are not saying that recession will not happen. Recession will happen, but it would be a soft landing. That is, the impact of that recession will be very low. Okay, Trisha.
Okay, got it, got it. And another question was, I am almost about to finish the course, and it's been like 2 months since I've taken it. So how should I proceed next? Like, what is the next step?
Okay, like you just keep on having those things that you have with you already, like the recorded sessions, and like keep on attending the live lectures. Okay, like quite soon, like for all the people like who are already part of this, like we'll be keeping the placement training sessions, and that like will be guiding you for mock interview. So that's the next step, like that will happen after half a month or so. Okay, so that's like completely planned for you guys, not to worry. So as you progress in the curriculum, the things will come to you. Okay, like automatically.
Thank you.
Any other questions like regarding the regarding the topics we discussed today? Okay. And just tell me one thing, that did you guys learn something new? Did you guys learn something new? A yes or a no in the chat box. So you want to learn about these concepts. I agree. And the thing would be